Okay, good afternoon, everyone. Welcome back to our options education webinar series. My name is Tony Zhang. I am the chief strategist here at Options Play. And today we're going to be talking about our most popular topic, which is generating consistent income with weekly options. I say this is our most popular topic because this is by far the most popular trading strategy that you guys utilize with options is selling covered calls, cash secured puts, and some of you like to trade credit spreads, but the most popular strategy is covered calls. And the techniques for how to generate income is really the same across all of these different strategies. So today we're going to focus on talking about using covered calls to understand what are the best practices and techniques for trading these types of strategies. But you can take what you've learned here today and apply it to cash secured puts and even credit spreads. And for those of you that own some leaps instead of owning stocks, you can also utilize this strategy to generate income on the long options that you own. So today I'll go over, I'll try to spend the least amount of time on the slides going through the best practices and methodology for utilizing this type of strategy and how to yield the highest amount of income for your portfolio. And that really is using shorter dated options, the weekly options that will be able to consistently help you generate the highest amount of yield for your portfolio. So we're going to talk about that. I'll walk you guys through the methodology and the best practices. And then what I really want, the most important thing for those of you that are on this webinar to learn is actually not necessarily the methodology, but actually how to automate that using our tool Options Play. That's the most important thing because I want all of you to be able to finish this webinar and immediately afterwards be able to log on to your Options Play account and feel comfortable enough to start utilizing these types of strategies for your portfolio immediately. And so that's really what I hope to be able to convey to you guys here today. This webinar is recorded, so you'll be able to get the recording about 30 minutes after we're done here today. I'll also include the slides for you so that you can actually follow along at home when you're watching the video with the slides in front of you. The slides have some important links in there, so I highly recommend you to download those links, those slides after you're done while you watch that recording. So let's just go ahead and get started here. I'm going to go over three very simple things. What is a covered call, why you should consider using covered calls, and lastly, how to generate consistent income using this strategy. Now, like I said, I'm going to use covered calls in my example because that's the most popular trading strategy. But for those of you that are selling cash secured puts, for those of you that are selling credit spreads, you can utilize what you learn here today for the same type of strategies. So before I get started, let's just to make sure that I have everyone can hear me, please type yes into the chat window if you've traded these types of strategies before, whether a covered call, cash secured put, or credit spread, and no if this is relatively new to you, just so I get a feel for kind of who's in the room here. Okay, so mostly yeses, a couple of nos. Sounds like most of you are fairly familiar with this strategy, which is great. So what I really want to do is focus the time less so on explaining these strategies and more so on showing you what are the best practices for these types of strategies. So we'll talk about how to automate these types of strategies using Options Play. Again, that's the most important piece so that you finish this not only understanding the knowledge, but knowing how to utilize our tools to help you find the optimal covered calls, cash secured puts, and even leveraging that into some credit spreads for those of you that like to trade the more advanced strategies. And lastly, what I will spend a little bit of time is talking about the exit strategies for this type of trade. So what is a covered call? It's very simple. It takes your position, meaning your existing stock position, at least 100 shares of any stock that you own. You can take that position, you can sell a call against that stock that you own for income, and that combined strategy is what we call a covered call. Now, this webinar is really for those of you that are beginners or advanced traders equally, because almost every single one of you probably owns some stock in your account. And the reason the cover call is the most popular strategy is because you can generate income on the existing assets in your portfolio, meaning the stocks that you have in your portfolio, without adding any additional risk. It's the only strategy that you can do with options that doesn't add additional risk to your existing portfolio. That's why it's the most popular strategy. And if you own that stock in your account today, especially for the stocks that aren't yielding you any yield, such as the non-dividend paying stocks, this is a great way to add some yield to those stocks. And even on the stocks that are paying a dividend, you can enhance your yield through this strategy. So it's really taking advantage of the assets that you already have in your account and adding some additional yield. And that's something you should consider regardless of what your views are in the market. And this is a strategy that's useful in pretty much all market conditions, whether you're bullish, whether you're bearish. This strategy does perform the best in a sideways market, which is where we are right now. So it's certainly an optimal time to consider taking a look at these types of strategies to generate some additional yield in your portfolio, especially when the markets are going sideways and you're not getting a lot of capital appreciation for the stocks that you own. Adding covered calls is a great way to add some additional income or yield to that portfolio that's kind of trading sideways right now. So why should you use covered calls? This is for those of you that are relatively new to this strategy. You can take this and expand out to cash secured puts. It's very similar. It generates consistent income in your portfolio. It lowers the volatility and the net cost basis of the stock that you own. So these are primary benefits to why you should consider selling covered calls. And the best part in my opinion, is that it's a strategy that you can use on the existing stocks in your portfolio. Again, you don't have to add any additional risk. You don't have to buy anything. You can use the existing assets in your portfolio and start generating some yield. That's why it's the most popular strategy. Beyond the fact that you can do it pretty much at all times, pretty much all the other option strategies that you can trade, there's some form of timing involved. With covered calls, you really don't have that timing nature. You can basically sell cover calls month after month, quarter after quarter, and generate some additional yield. So it really takes the amount of research time that it requires to sell cover calls. It's relatively short. And once we show you how to do it on Options Play, you'll see how you can, within a few seconds, know if there's an income opportunity on these stocks in your portfolio. Now, this strategy does have some limitations. It does limit the upside return of your stock. So when you sell a covered call, you have to pick a strike price. You are limiting the upside return of your stock above that strike price. So that is one of the limitations of selling covered calls. This does require at least 100 shares of the stock that you own. So if you have some stocks in your account that you only have 50, 60, 70 shares of, this is not a strategy you can do. You must have at least 100 shares before you can sell a covered call. And lastly, you do risk losing the stock by selling the stock at that strike price. So if it's a stock that you own for quite some time and you don't want to get rid of, be careful with these types of strategies because you do have that risk of losing that stock. However, everything that we're going to be talking about here today is designed to help you minimize the risk of losing your stock. That's always a risk, but we can try to minimize that to as close to zero as possible if we follow certain guidelines. And that's what we hope to talk to you guys about today. So how do you generate consistent income? Now that we've talked about what is a cover call, why you should use it, let's talk about how can you generate consistent income. And the key here is consistent, right? Because we all know how to generate generate some income by selling one contract or one cover call. But how do we do it month after month, quarter after quarter to generate a consistent income stream? And the first thing to understand in terms of being able to generate consistent income with these types of strategies is that you have to understand it's not a one-size-fits-all strategy. Each one of us is different. We all have different priorities in terms of what our risk tolerance is. We all have different schedules that determine how often we can trade. These are things that help guide how you should utilize these types of strategies. So it's first and very important to understand that we're all different, and we need to understand why or how that affects how we approach these types of strategies. Because once you understand that, it's actually a really simple strategy as to how to generate consistent income. It's simply choosing a suitable expiration date and strike price based on your personal preferences. When you're selling cover calls or cash secured puts or credit spreads, there's only two things that you need to account for. figuring out an expiration date and figuring out a strike price. How do you know which expiration date and strike price to choose? That's what we're going to spend some time going over here today. But the key here is to use the same methodical approach each cycle. So what I mean by that is once we learn how to pick an expiration date that suits us, we want to make sure we stick to that month after month, quarter after quarter. Once we learn how to pick a strike price that suits us, then we want to make sure we choose that same method month after month, quarter after quarter. That's how you're going to gain consistency. If you switch your strategies from month to month, you choose different strike prices and different expiration dates, that's when you're not going to get that consistency. So it's really using the same methodical approach each cycle. And that's really what options play is designed to do, is help automate that so that you're able to be consistent in how you choose your expiration dates and strike prices. Lastly, like I said, automation facilitates consistency. So we want to show you how to utilize options play to automate these process of selecting expiration dates and strike prices to help you gain that consistency. So before we move on, I just want to do a quick poll here. Many of you have said that you've sold cover calls or cash secured puts or credit spreads. So let me ask you, what expirations do you typically use when you're selling options? Do you use expirations that are less than 1 month, 1 to 2 months, 2 to 3 months, or greater than 3 months, just to get a feel for who's in the room here? So it looks like the vast majority of you use options that are 1 to 2 months out. About 20% of you less than 1 month, 20% of you greater than two months, but most of you are in that 1 to 2 month range, which is fairly normal and expected, which is good. Okay, so this is good. So 25% of you use less than 1 month, 62% of you use 1 to 2 months, and 14% of you use 2 to 3 months. So this is great. This is good to understand kind of what you guys are using. So let me just show this here. You guys can see this poll right here in front of you. So let's talk about what expirations you should use, what timeframes you should use, okay? Let's close out this poll. So I have 3 strategies up here. This looks like this PDF got a little screwy here, but I have 3 timeframes up here. If you guys can't see that, this says short term, this says medium term, and this says long term. I apologize for the images that they're kind of overlaid with the text here. So what we have here is I have 3 categories. I have active traders, I have casual investors, and I have buy and hold. Okay, so these are the 3 types of traders that you typically see. So I myself, I'm an active trader. So because I have the time to look at my account pretty much every single day, I would typically choose short-term expirations, anywhere from 21 to 49 days out. So I apologize again for the PDF. I'll make sure I fix that before we send that out. So active traders, so if you're like myself, you have the ability to look at your trading account pretty much on a daily basis or a weekly basis, you would choose short-term options anywhere from 21 to 49 days out. So 3 to 7 weeks out. That's really where the weekly options come into play. Casual investors. These are for those of you that might look at your account once every a few weeks, once every couple of weeks. You would typically choose medium-term options, anywhere from 49 days out to 89 days out. So about 1.5 to 2 months to 3 months out. And then lastly, buy and hold. These are for those of you that are long-term buy and hold investors. You might look at your account once a month or once a quarter. It'd be suitable for you to look at expirations that are anywhere from 3 to 6 months out. Okay, so it doesn't sound like any of you are really falling in that category. Most of you are selling options either here in the short term, less than 1 month, or 1 to 2 months here in the medium term category. So what I wanted to look at is the different expirations and kind of how that impacts these types of strategies. So when we sell short dated options, you have what we consider more certainty, because between now and expiration, that's maybe a few weeks out or maybe 1 month out, you have a fair amount of visibility into what may happen between now and expiration. Things like earnings events, dividends, product releases, these are things that typically have a catalyst on the stock price or a big move on the stock price. You generally have some visibility into when that's going to happen the next month or so. Versus if you're doing long-term options 3 to 6 months out, you have a lot less visibility. So you have a lot less certainty as to what's going to happen between now and expiration. So how does that actually affect the income you receive? The more certainty that you have, the less income you're going to receive. The less certainty you have, the more income you're going to receive. So that's the relationship we have between certainty, which is really volatility, and incomes. The less volatile something is, the more certainty we have, the less income we receive. The less certainty, the more volatility, the more income we're going to receive. So the question becomes, which expiration should you choose, or which expiration gives us the highest yield? And this is something we wanted to test. We wanted to say, what happens if you sold 1 month options, or 2 month options, or 3 month options, or 6 month options? We wanted to test out all of these different scenarios across the S&P 500 stocks over the last 10 years. And what we found is that it's actually best to do shorter dated options in terms of getting the most amount of yield. Now, why is that? There's really 2 reasons. Number one, we found that it's always best to avoid selling calls during earnings. That was the biggest contributor to underperformance of this strategy. So this applies to if you're selling puts. This applies as well if you're selling credit spreads. Avoid selling options during earnings. And the reason for that is because when you have an earnings movement, an earnings play, that's when you have potentially a large shock to the price of the stock, and that contributes to underperformance of this strategy. So the reason that 1 month calls tends to outperform doing longer dated calls is because when you sell 1 month calls, you can do that roughly 12 times a year. So meaning we know that there's 4 earnings announcements every single year. So 4 out of the 12 that you sell, or about a quarter of the options that you sell, have this large uncertainty factor built into it. Versus if you're selling 3 month calls, you can only do that 4 times a year, which means that every single one of the calls that you're selling has this large uncertainty factor of earnings built into it. So 100% of the calls that you're selling have this large uncertainty factor built into it. You basically can't even avoid it if you wanted to. So that's really why it's better to sell 1 month calls, meaning shorter dated calls, versus longer dated calls. The second reason that we generally find that it's better to sell short dated calls is that premium is not linear to time. What do I mean by that? So when you sell a 1 month call, let's say we get X amount of premium. Let's say we get $1 when we're selling a 1 month call. What we generally find is that if we go 3 months out, we're not going to collect $3, even though we're going 3 times as further out. We generally find that we're only going to get roughly $2, or twice the amount of premium of a 1 month call. So this is why you're really not getting paid to go further out in time. It's actually better to do 1 month calls. You can do that 2 times in a row, collect the same amount of premium as a 3 month call, and actually avoid that 3rd month when there's earnings, and still collect roughly the same amount of premium. So that's really why, based on our historical backtest, it's better to sell shorter dated options versus longer dated options if you have the ability to do so. Now let's move on to strike prices. So before we move on, make sure you make a mental note to yourself. Which one do you fall under? Active traders, casual investors, or buy and hold? Based on the last poll we just did, sounds like most of you will fall somewhere in this middle range, the casual investor range, 1 to 2 months out. However, like I said, if you have the ability to do shorter dated options, the weekly options, that's really where you're going to get the best bang for your buck because of these 2 primary things that we've just said. Avoid selling calls during earnings, selling those weekly options, and then selling those weekly options to collect the most amount of premium to try to generate the most amount of yield for your portfolio. Now, before we move on to the next one, what I want to do is ask a similar type question now. So we just talked about how do you select your expiration dates. Now let's talk about how do you select your strike prices when you're selling options. This whether you're selling cover calls, cash secured puts, credit spreads, it doesn't matter. Let me know how you select your strike prices. Do you use strike prices that are a certain percentage away from the current price? Do you use a dollar amount away from the current price, or do you use delta to select your strikes? So it looks like right off the bat, most of you use delta to select your strikes. About a third of you use a dollar amount, and about 15% of you use a percentage away from the current price. So it looks like at this point, about 2/3 of you have voted. So that should give us a decent sample size here. So let's share the results here. So most of you will use delta to select your strikes, and in our opinion, that's the best way to select your strikes because delta will account for all changes in volatility. So if there's an event coming up and the stock's more volatile, it'll adjust that accordingly. The second highest one is actually using a dollar amount. So this is actually, in my opinion, probably the least favorite way to go about doing so. And the reason for that is because the dollar amount doesn't adjust for volatility at all. So when things are quiet, you're not going to be able to find it doesn't adjust for that. At least percentages can adjust for different stock prices and different volatilities. With dollar amounts, you don't get any of that. So we generally prefer to use deltas first, or second case, using percentages, third, using dollar amounts. So for those of you that are using dollar amounts, I hope that you're able to learn something new here today, because when you're selecting your strike prices, okay, sorry. Now I'm sharing the poll here so that you can see that 53% of you say you use deltas to select your strikes. About a third of you say use dollar amounts, and about 13% of you say use percentage away. Okay, so let's take a look at that. What does that actually mean? So here again, I apologize for the images. I'll try to get these fixed before we send it out. But I have 3 different risk tolerances. So how you select your strikes should be contingent upon what your risk tolerance is. So I have 3 risk tolerances. I have conservative, I have optimal, and I have aggressive. So when we're talking about cover calls, a conservative risk tolerance is really for those of you that are looking to minimize the risk of losing that stock. So if you have some stock with some really low cost basis and you don't want to lose that stock because you don't want to generate a tax bill, perhaps those of you that have a dividend paying stocks, you rely on that dividend for income. These are the types of scenarios where you would consider yourself a conservative risk tolerance when it comes to selling covered calls. Okay, you want to use a delta to help you decide which ones to use. So right now, again, I apologize for this image being cut off here, but this is actually saying a 10 delta call. So if you're using delta, that's great. Most of you are. When you're selecting conservative cover call strikes, you want to use about a 10 delta call that you're selling. For those of you that are aggressive, this is for those of you that are looking to chase as much yield as possible. So if you're trying to generate as much yield as possible and you don't mind losing that stock, or if you don't mind that stock being called away, you can select strikes that are more aggressive. So about a 30 delta call. Again, I'll fix these before I send them out. And lastly, if you're optimal, which is someone like myself, I'm not too conservative, yet I'm not too aggressive. I'm somewhere in the middle. I use deltas that are around a 20 delta strike. And the reason we use delta is because delta will automatically adjust the distance of the strikes from the current price based on volatility, because delta is derived from the volatility or the implied volatility of the option. So if volatility is really high, delta will automatically select a strike that's further away. And if volatility is very low, delta will automatically select a strike that's closer to the current price. So it's automatically adjusting with the market. And that's really why we encourage you to use delta to help you determine which strikes to use, and not dollar amount or percentages. And so delta is the inverse of POW, or probability of expiring worthless. Meaning if you're selling a 10 delta call, then that call has about a 90% chance that you're going to keep your premium. A 20 delta call has an 80% probability of expiring worthless. So about an 80% chance you keep your income. And a 30 delta call has a 70% probability of expiring worthless. So it's basically the inverse of the delta. It tells you what is the probability of you keeping that income. So based on all of these different strike prices that you can choose, what is the difference? How does that affect the income that you receive? So when you select a conservative strike, a 10 delta call, that means that you're selecting a strike that has relatively low probability of that call being in the money at expiration. So that means you're selecting relatively high strikes strikes that are very far away from the current price of the option. This gives you more upside for the stock to grow before that stock gets called away. And in exchange for that, you're going to get less income for that specific trade. So on the other hand, if you're selecting an aggressive strike, you're selecting lower strikes, strikes that are closer to the current price of the stock. This gives your stock a lot less upside or a lot less room before the stock gets called away. And in exchange for all of that, you're going to get more income for the calls that you sell. So what we wanted to do now is to backtest all of these different strategies, aggressive, optimal, and conservative, and see what is the actual yield that you get over the S&P 500 stocks for the last 10 years. And the answer, again, we found was that it's best to be on the conservative end of the spectrum when it comes to trading these strategies. And this really comes because of the fact that all option selling strategies, whether you're selling covered calls, cash secured puts, credit spreads, even iron condors and butterflies, they have what's considered a negative risk to reward, meaning the reward that you receive is limited to the credit or the premium that you're receiving on the trade. However, the lost opportunity on these trades are unlimited. Okay, so if you're selling a cover call, you have a $100 stock and you sell a 110 call against it, if the stock shoots up to $150 or $200, you've lost out on quite a bit of opportunity for your capital appreciation to grow because you've sold that covered call. And that lost opportunity, even though isn't an actual loss to your account, is certainly a lost opportunity. So that's why we consider these strategies a negative risk reward, because your reward is limited, but your upside opportunity that you've lost is unlimited. So what that means is that what's really best from what we've found based on our back test is that giving your stock upside room to run is much more important than trying to collect a few extra cents by getting more aggressive on your strikes. When you get too aggressive, you miss out on too much opportunity for the stock. And the reason that you own the stock is because you think it's going to appreciate in value. So it doesn't make sense to cap that appreciation just to collect a few extra cents in cover call premiums. So we found that it's better to actually collect smaller premiums, but give your stock that room to grow, because that really allows you to allow your portfolio to grow while still collecting some consistent income month after month. So that's really what we have found to work with selecting your strike prices. So how do we know, once we've selected our expiration and strike price, if we're getting enough income? So sometimes you could follow exactly the rules that I just specified here. Let's say you're a short-term trader and you're conservative, so you go through that process. How do you know that the call that you're looking at yields enough income? And the answer is really compare the cover call yields to the dividend yield. If you don't know how to calculate cover call yields, don't worry. Options Play does that for you, so you don't have to calculate anything yourself. And the rule of thumb here is that you want to beat the dividend yield with the cover call yield that you're looking at. So I have three scenarios here up front just for illustrative purposes. So if you have a stock that pays you a 1% dividend and you're looking at a cover call that pays you a 3% yield, this is the type of scenarios that you're looking for. You want to beat the dividend yield of 1% with the cover call that has yielding you 3%. So you're increasing your yield from 1% to 4% overall by adding this cover call. The second scenario is what we consider the bare minimum. So if you have a stock that pays you a 3% dividend, the minimum amount that you should take a cover call on is at least 3%. Anything less than 3%, not something you want to consider, which is what I have here on the right-hand side. So if you have a stock that pays a 3% dividend and you have a cover call that pays you only a 1% yield, that is an example where you're not getting enough yield for the risk of potentially losing your stock. So you're only increasing your yield from 3% to 4%, not worth your while. Okay, so make sure that you consider this when you're selling your cover calls. And I'll go through all of these steps. There's really only two steps: selecting an expiration date and strike price, and calculating or comparing the yields to the dividend yield to help you decide, is this a trade I want to make? So I'll walk you guys through as many examples as possible so that you immediately after this webinar feel comfortable with doing this on your own. So if you follow all of these things that we just talked about here today, what can you expect? So one of the things that we, just a quick recap, right? When it comes to selecting expirations, it's best to prioritize certainty over collecting fat premiums. And when it comes to selecting strike prices, it's much more important to give your stock upside room to run prioritize that over collecting as much income as possible. So based on what we've found, based on all of our back tested results, it's better to do shorter term options anywhere from 21 to 49 days out. These are the weekly options, and there are lots of weekly options listed out there, and you should take full advantage of them because they really provide you with the most amount of yield, the most amount of flexibility in terms of trading. And with the weekly expirations, you're able to get a lot more granular with the strikes because they list a lot more strikes in the weeklies than they list on the 3-month or 6-month options. So we found that based on all our back tests, roughly the 15 delta call really gives you that best risk to reward payoff graph for these types of strategies. Somewhere right in between optimal and conservative is where you're going to get the best bang for your buck. And these types of strategies will return on average of about 3.4% annualized return above the stock performance that you have for your stock. Now, this is an average number across the S&P 500 stocks. They do differ quite a bit from stock to stock, but this gives you an idea of what the average looks like across the S&P 500. So with that, let's actually go through some real examples showing you options play and how it can help you automate and go through this process as easy as possible. So this is the options play tool. For those of you that have never seen this before, welcome. This is what you have access to. If you don't have it, please sign up for a free trial at optionsplay.com. A link will be included in the slides that we send afterwards. The platform itself is divided into 3 sections. You have trade ideas and watch list here on the left. Trade ideas provides you with the fresh ideas every single day. Watch lists are the stocks that you want to watch, and we have a bunch of pre-built watch lists for you. So the middle panel is our security analysis panel designed to give you quick snapshot data so you can quickly understand what's currently going on with the stock. And lastly, we have trading and income here on the right. Trading tab is designed for those of you that want to speculate on a specific direction. So you can select I'm bullish and be presented with 3 bullish strategies, or click on I'm bearish and be presented with 3 bearish strategies. And using the P&L simulator, you can see how each one of these strategies will perform side by side so that you can definitively make a decision as to which strategy is best suited for you. Today, what we're going to focus on is the income tab. So we're going to talk about how to generate income for both covered calls and cash secured puts. And what I've done is I've set up a watch list here, a covered call watch list. And what I've put in here is a list of stocks that many of you probably own in your account. I selected some of the biggest names that you will most likely have in your account. Just for illustrative purposes, this is by no means a solicitation to trade any of these securities or stocks. This is simply using this for educational purposes so I can quickly show you how easy it is to find a cover call or a short put opportunity on any stock that you own or you might want to own. So let's take a look at Apple here. And before I look at Apple, what I want to show you guys here is on the income tab at the very bottom, there's a button that says income settings. This is where you want to start. If you're first time using options play and you want to sell cover calls, before you do anything, come to the income settings tab. This allows you to select the appropriate time frame that suits you. So remember on the slides, I was talking about 3 categories: short, medium, or long term. So depending on how often you trade, select the time frame that suits you. Again, remember, selling cover calls and cash secured puts, it's not a one size fits all strategy. Make sure you select the one that suits you. So I trade fairly often, so I prefer to be on the shorter end of the spectrum when it comes to time frame. And my risk tolerance is really optimal because I'm not too conservative, I'm not too aggressive. I like to be somewhere in the middle. Once I select these settings, I can save as default. And for those of you that like to sell cash secured puts, you can set different settings for your puts. So on the puts, I like to get more aggressive. So all you have to do is click on Save as Default. And now for any symbol that you type in, and I highly recommend you to set up a watch list with the stocks that you own to make this as easy as possible. All you have to do is click on a symbol, and within a few seconds, you'll know exactly which cover call might suit you for you to trade. So Apple's at 185.50 right now. This is telling me to look at, and then ask you, do you own shares of Apple? So I can type in yes. You can even enter the number of shares. So let's say you own 200 shares of Apple instead of 100 shares. It will break down the trade for you exactly and give you the ideal starting point based on your personal preferences. And this is designed so that you don't have to pull up an option chain every single time you want to sell a cover call, because that process sometimes can be quite uh, tedious and sometimes confusing because you're looking at so many different expirations and strike prices. Here, it provides you that exact starting point based on your preferences. So Apple's at 185.50 right now. This is telling me to look at the July 20th 192.5 cover calls. And for those of you that said no to selling a cover call before, if you're new to this strategy, it breaks it down for you in plain English. So it tells you that selling the July 20th 192.5 calls will generate $212 in premium, $212. They produce a 9.5% annualized return, and there's a 78% chance that this call will expire worthless. So here I have all the necessary points for me to understand, is this a trade I want to make? Because it gives me that starting point. It chooses an expiration that's 22 days out, which is ideal in that range that I'm looking for in the weekly options. It's giving me a strike price of 192.5. So it's telling me that there's a 78% chance that this call is going to expire worthless, which is right in that range that I'm looking for, which is roughly 80% or a 20 delta call. It does all of that work for me, and it calculates the yield. So this is telling me my yield is 9.48, so roughly 9.5% on a stock that only pays me a 1.59% yield. So 1.6% yield right now if you own Apple, and I'm guessing many of you own Apple in your account. This is not what I would consider a high dividend paying stock. It's certainly not a bad paying stock, but it's not a high paying stock. But you can add an additional 9.5% to that by selling cover calls against it. So basically, when you're selling a 192.5 cover call, you're basically saying, I don't think Apple's going to go above 192.5 over the next 22 days. And if that doesn't happen, you get to keep all $212, or about half, and that comes out to be roughly half a percent of the underlying price. So you're actually saving or reducing your cost basis of this stock by about 0.5% over the next 22 days. And if you can do this consistently month after month, quarter after quarter, you're going to reduce your cost basis by roughly almost 10% at the end of the year by selling these types of cover calls. That's why this is an attractive and one of the most popular strategies by option sellers or option traders in general. And this is all designed to give you instant strategies just by clicking on a symbol without having to do any additional work or searching or looking for anything. It presents all of these data points for you. And once you've decided this is a trade that you want to make, you can click on the trade button. We have a strategy checklist that will go through a few different things. So especially if you're brand new, you want to make sure you spend the time looking at the strategy checklist. Things like, is this probability of expiring worthless good? How's the annualized return? Like I said, one of the things that you want to look out for is earnings. So we'll check, is there earnings between now and expiration? So if there isn't, you're good to go. And lastly, we look at spread and liquidity, something that we see that a lot of stock traders tend to neglect to look at, because when you're trading stocks, you're not too concerned about the liquidity. But when you're trading options, that's a much bigger concern, because the last thing you want to do is sell a cover call that you can't get out of later because it's not very liquid. So we use the spread between the bid and the ask price of the option to determine the liquidity of something. And once you've determined this is a trade you want to make, we give you all the details on how to enter this strategy into your broker's platform. So everything that you need to fill out an order ticket is provided to you right here, including the bid and ask price, so that you can see what the current market is trading at, so that you can place your limit orders accordingly. So what I really want to do here now is just to show you guys as many examples as possible. So once you've created your income settings here at the bottom, that's all you need to do. You can now click on any single stock. Let's look at Johnson & Johnson, trading at 122 right now. And within a few seconds, without having to pull up an option chain or search for anything, it immediately tells me to look at selling a July 20th 127 cover call. So a call that's roughly $5 away from the current price. This is telling me that this yields an 8.5% yield on a stock that pays a pretty hefty 3% dividend. So if you own Johnson & Johnson stock, you're getting paid 3%, which is pretty good, but you can increase that another 8.5% by selling these cover calls. And that really is what's attractive about these strategies, especially in a stock that's relatively weak. Perhaps if you're holding on to this, you've probably suffered some losses over the last few weeks and months. you can supplement some of those losses or offset some of those losses by selling cover calls against it. This is really why, again, this is one of the most popular trading strategies when it comes to stocks that you own in your account. Let's just look at some more examples. Pepsi trading at 108.68. As you can see, this is telling me instantly to look at selling a July 20th, 113 call. So roughly about $4.50 out of the money. Tells me the yield on this stock is 8.4% on a stock that pays a very hefty 3.5% dividend yield. So you're increasing your yield from 3.5% by adding the 8% to 11%. If you're going to sell these cover calls throughout the entire year. And you're going to do that you're going to roughly collect about 0.5% of the underlying in just 22 days. So you can reduce your cost basis of the stock by 0.5% in just 22 days, 3 weeks time. This is exactly why this is a strategy that you should consider taking a look at this. And I just want to point out, if those of you that are using option chains, one of the things that you guys will find is that when you're looking at option chains, let me see if I can find one here real quick. This is the type of screens that many of you probably learned how to trade options on. I certainly did, and what I found is that when you're looking at an option chain, it's almost like looking through a phone book. You're searching through pages and pages of different expirations and strike prices. And what you really want to do is figure out which ones you want to trade. And when you're looking at these types of strategies, when you're looking at an option chain, you're simply trying to search for a specific income. And what you're not doing is following a methodical approach. It's really difficult to look for the same methodical approach when you're manually searching every single time. When you're using options play, it's automatic because you don't have to think about, oh, I have to look for the 30-day option. Oh, I have to look at the 20 delta call. It already does all of that work for you and instantly provides you where that 30-day 20 delta call is. So here for Intel, it's looking at, which is trading at 49.25. This is also a stock that's taken a huge beating over the last few weeks. So if you own this stock, you certainly might want to consider adding some cover calls to it because you're getting a 2.5% yield on this today, but the cover call is yielding almost 12%, telling you to sell a cover call that's roughly about $3 out of the money over the next 22 days, collecting 0.7% over the next 22 days. So you can reduce your cost basis by 0.7% over the next 22 days, which annualizes out to almost 12%. That brings your total yield for the year to about 14% by selling cover calls on the Intel stock that you own. So especially in the sideways market, in the market where the average stock really isn't going anywhere, this is one of the better strategies to use, because you can really help offset the fact that the markets are going sideways with some additional income by selling cover calls. So let me just go through a few more examples here. Tesla trading at roughly 350 here. Again, I don't have to pull up an option chain or go searching through it or scrolling through it. Within a few seconds, it can tell me to look at the July 20th, 395 cover call, so about $45 out of the money, yielding a hefty 24% on a stock that pays you 0 dividends. I know a lot of you like Tesla stock. It's kind of a contested stock, a lot of bulls and a lot of bears. People disagree a lot on this stock. Many of you love this stock. So if you hold this stock in your account, you can reduce your cost basis on the stock by 1.5% in the next 3 weeks by selling this cover call. Imagine if you can buy all your stocks 1.5% lower than the current price that you're paying for it right now. So for those of you that don't own Tesla, and maybe you want to own Tesla, you can buy the stock and sell the cover call at the same time, and that will also reduce your cost basis of the stock by 1.5%. And that's just over the next 22 days. If you do this month after month, you can reduce your cost basis by a substantial, almost 25%, if you're able to do this month after month. And that's really why this is one of the most popular trading strategies amongst options traders. I'll just go through one more example here. I just want to show you guys Gilead's trading at $70. Let's take a look at what it offers here, telling me to look at the July 20th, 74.5 cover calls. So 11% yield, about 2/3% that you're going to receive of the underlying in the next 22 days on a stock that pays a really hefty 3% dividend. You're going to add an additional 11% to it, bringing your total yield to 14%. So again, this tool is designed to make your process of finding which cover calls to sell as easy as possible, because I can click on a name and within 2 seconds know exactly what my starting point is, know how much yield I'm getting, and know exactly if this is a trade that I want to make. If not, I can simply move on to the next one. I don't have to spend hours on this chain. If I had 20 stocks, it would take me forever to go through pages and pages of these stocks to figure out which option do I start with, and then calculate the yields, and then decide and then find out is there earnings between now and expiration. This does all of that work for you into one very simple workflow. You type in the stock, it tells you which cover call to sell. And for those of you that don't like to sell cover calls, maybe if you like to sell puts, just click on no if you own shares of Pepsi, and it will provide you with the short put to sell. So here, if you want to buy Pepsi, instead of buying at 108, you can sell the 106 put, which allows you to buy the stock at 106. And for doing so, think of it almost like placing a limit order at 106. It allows you to collect $93 just to put in this order, which reduces your cost basis by almost 1%. So if you end up owning the stock at 106, you're also going to collect 93 cents. So you actually own the stock at 105.07 as opposed to 108.68. This allows you to potentially do this a few months at a time before you start owning that stock. So you might have collected a few $100s in income before this stock gets put to you. It's also a way to consider dollar cost averaging into a stock that you want to own, but you don't want to buy all of it at one price at the current price right now. So I just want to do a quick recap. When you set up Options Play, make sure when you click on the Income tab, you come in here to set up your income settings so that you have the correct settings for time frame as well as risk tolerance. Once you do that, you should set up a watch list of all the stocks that you own or want to own so that you can quickly type in any symbol and within a few seconds know exactly which stocks have opportunities to sell cover calls, which ones don't. Let me see if I can give you an example of one where there isn't really any premium to sell. So here on Sprint, as you can see, it's a $5 stock that doesn't trade very much. As you can see, it's telling me that I couldn't find you a cover call to sell. This is designed to save you time, because if you had to pull up an option chain for Sprint, look through all the expirations, look through all the strike prices, calculate your yields, and then find out that there's not enough yield or there's not enough premium, you end up wasting a lot of time. This tool is designed to save you that time so that when you see a message like this, you're not wasting any more time. You can move on to the next stock. Look at Ford. I think you might get a slightly different message for Ford. So as you can see, Ford, it's telling me that it cannot find me a short-term optimal call. It's finding me the next best alternative. So when we can't find you a call that meets your criteria exactly, we'll try to find you the next best alternative. Now, for those of you that are brand new to this strategy, I don't recommend you to trade the alternative strategies. For those of you that have experience trading, then you might want to take a look at those alternative strategies. And you can always pull up the options grid, which shows you all the available options across the different time frames and the risk tolerances. And this is designed to give you kind of a view of the chains without showing you the full chain. So as you can see here on Ford, there's really not much available. There's only the September 1187 strike call to sell. Not really something for me. You would clearly just very quickly move on. This is so that you don't waste any additional time on this stock unnecessarily. So we want to make your process of selecting a cover call or cash secured put from a few minutes down to just a few seconds, and allow you to quickly make a decision as to whether this is something you want to do. Because I know most of you don't have a lot of time to sit there in front of your screens all day looking for strategies. You want to be able to find them quickly when the options expire, sell them, and maybe come back a few weeks later before you go ahead and do that. So this platform is designed to make that process as easy as possible. So let's just go back real quick. I just want to cover 3 different things before we wrap this up and open up this for Q&A. So let's talk about exit strategies. Once you've sold the cover call, there's basically 3 scenarios that you might come across, and we want to go through what you should do with each one. So the first strategy, or the first scenario, you sell your stock, you sell your cover call, the stock shoots higher. This is really where we see a lot of people tend to panic because you see this large unrealized loss on the short call that you have, and people don't really know what to do. We see a lot of people close out their cover call. They buy back that call because they don't want to continue seeing large losses on that short call. And this is really where we suggest that you don't panic. This is really you don't want to panic when the stock goes above your strike price before expiration. You want to hold on to that trade. And if you need to roll that cover call, meaning buy back that call and sell another one, you only want to do that in the last week before expiration. So if you sold the cover call and you still have 3 or 4 weeks left and the stock goes above that strike price, don't panic, don't roll that, hold on to it, because number one, you give it some time or the opportunity potentially for that stock to come below your strike price. And number two, if you roll that early, you've effectively locked in a loss for your trade. You don't want to do that. You still want to try to collect that time premium over the next 3 to 4 weeks before expiration and let that help mitigate some of that loss. And that really helps you have the best returns for this type of strategy in the long run. The second scenario, if you've sold the cover call and the stock trades sideways, this is really kind of your best case scenario. This is where you want to simply hold on to your cover call, let it expire worthless, and come back the following Monday and sell another one. Lastly, if you sell a cover call and the stock drops, this is the only time where it makes sense to roll your positions early. And when I say roll your positions, I mean buy back the cover call that you've sold and sell another one. And the rule of thumb here is that if you can buy back the call that you've sold at 20% of the original premium that you've sold, that is your rule of thumb as to when you should consider doing that. So if you sold the cover call for $1 and it's now trading at 20 cents or less, and you can buy it back at 20 cents or less, go ahead and do that and sell another one. This is what we consider hitting doubles and triples, because you can, in the next 3 weeks, you can potentially sell 2 or 3 different calls throughout that. If the stock continues to move lower, you can continue collecting that premium. Instead of over 3 weeks, you might be able to collect most of that premium over just a week or two. So those are the 3 different scenarios that you will come across when you're selling cover calls and how to handle them, generally speaking. So just a quick wrap up here. Again, make sure that you select your income strategies based on your personal settings, and you can do that here at the bottom under your income settings button. And all you have to do is simply click on a symbol, and we will provide you with the ideal starting point based on your personal preferences, so that you don't have to spend all your time going through pages and pages of option chains and manually searching for it, when all of this can be automated for you. Make your lives easier. Don't make your lives harder by having to go through these types of pages day in and day out. I certainly did it for many, many years, and we came to this realization that there had to be a better way. That's why we created Options Play, and I hope you guys can see that and use that to your advantage. So with that, I just want to thank everyone for taking the time out this afternoon. I will now answer any questions. So please, if you have any questions, please type them into the Q&A window or the chat window, and I will answer as many questions as I have time for. Mark's asking, what delta should you use writing cash secured puts? So again, same thing with the cover calls. If you're selling puts and you're conservative, you would use roughly a 10 delta call, optimal a 20 delta call, aggressive a 30 delta call. And those will be in the slides that I send you. So keep an eye out for those slides so that you can download that later. Michael, are you using annualized gains to compare income versus dividends? So we have both. We have both the annualized and the raw return, so that you can use both. The annualized is assuming that you are able to do this month after month, but you can also look at what the raw return is over just the time frame between now and expiration. So you have both to look at. I thought this might be geared towards more aggressive trading by rolling cover calls every week. How can Options Play help with that? Well, I'm not sure what you mean by that. So you wouldn't want to roll your cover calls every week. You would only want to roll your cover calls if you're able to buy it back for 20% or less than what you've received on the credit. Otherwise, I don't know why you would roll it every single week. You're just adding a lot more transaction costs for yourself. You want to sell short-dated options, let them expire, and sell them again. Unless the stock drops, that's when you can roll it early. John, what is the delta premium? I'm not sure what you mean by delta premium. The delta is simply a Greek of the option, and what that tells you is roughly the probability of that call being in the money. So what we use is the inverse of that. So if you have a 20 delta call, that means that has roughly an 80% chance that call is not going to be in the money. So when you're selling cover calls, that's really what you're concerned about is you don't want that call being in the money because that means your stock's going to get called away. So we use delta to help us approximate what is the probability of that call being called away, and that's why we use that to be able to gain consistency. Because if we constantly use a 20 delta call, then we know that 80% of the time that we sell cover calls, it's not going to get called away. That's how we gain our consistency when we trade these options. Since time decay is highest at 10 days to expiration, why not sell short-dated options? Great question. In theory, then you should only sell one-day options if that's the case. But the answer to that is because once you go too short at the 10-day options, you're not collecting enough premium to even necessarily overcome your commissions. So that's why you generally want to go at least 3 weeks out, because then you're going to at least get enough income to overcome your commissions. If you're selling two short dated options, you might only collect 10 cents or 15 cents. And if you're paying $7 on commissions, then you're wiping out half of your gains just to paying commissions. That's why we generally don't go too short unless you have free trading. You can certainly do shorter dated options, but also spreads tend to be much wider on a shorter dated option. So that's why there's some limitations to how short you can go. How about closing a cover call a few days before earnings and selling a new cover call after earnings? You certainly can do that. However, when you're when you're closing a cover call a few days before earnings, that call will have a huge amount of implied volatility, and you're going to have to pay for that when you're buying that back. So that's why we generally want to sell options before that expire before expiration, and then start selling them again after expiration. If you sell a cover call that includes earnings, then when you're buying it back, you're going to have to pay for that high volatility. So that's why we generally don't do that, Charles. Is there any way to track the ongoing P&L of a cover call? In other words, can we follow a trade from month to month, see the full profits and losses for each roll, and to keep track of cost basis? So yes, we do have that. So you can click on this, you can save a trade. So just to show you guys, you can click on the blue share button and you can save a trade to your profile. Once you do that, you can find the trades in your profile. They're under a section called Save Trades. So under your profile, you'll see a button here at the left-hand side called Shared Trades. And this you can use to look at all your trades, and it actually tracks the P&L of that trade. So when you click on your links, it'll bring up the exact trade that you saved, and will also provide you with the current P&L. So for this, as you can see, the trade P&L is 0 because the market hasn't moved since I saved it a few seconds ago. Any other questions regarding what we spoke about here today? Does options play take bid-ask spread or open interest to assess liquidity? Absolutely. So when you hit the trade button, one of the things that we have under our trade strategy or strategy checklist is spread and liquidity. So we use the bid-ask spread to calculate the liquidity of an option, and we give you a reading. It's basically red, yellow, or green. Green means good liquidity, yellow means average, red means poor liquidity. So here for this Intel one, the spread here of 35 cents by 37 cents is what we consider average liquidity for a spread like this. And that's based on a percentage of the amount of premium that you're going to be receiving for that spread. So yes, we do look at bid-ask spreads to determine liquidity. We don't use open interest because open interest is not always a good gauge of liquidity. Any other questions? One thing I want to ask everyone here is, we've been doing a lot of these webinars week after week. I want to do these webinars to help you guys and help you guys learn how to trade options better using our platform. If you guys have any suggestions on topics that you want us to cover with trading, please type them into the chat window, because we're just about to launch the July webinar schedule. So I want to make sure that I cover topics that you guys want to hear about. So please, if you have any feedback or comments or thoughts on what topics you want us to cover next month, please type them into the chat window and be happy to look at those when we put together our webinar schedule for July. Paul's asking, where is that save function? So you can access, and this works for any trading strategy that you see on our platform. So it doesn't matter whether you're looking at a cover call or a spread, you can always click on the blue share button, okay? And that brings up the strategy that you're looking at. And you can click on this link over here on the right that says copy this trade, and that saves that trade into your profile. Once you do that, you can find a list of all your saved trades in your profile under the section that says save trade or share trades, and you can click on that trade, and that will allow you to bring up that trade. And like I said, it tracks the P&L. So especially for those of you that are newer to options trading and you're not ready to place your first live trade, you can use this tool to help you track some trades and keep track of them, and it'll not only help you understand the trade, but it'll track the P&L so that you can follow this along over the lifetime of that trade, so that you can see how they would perform based on trades that you would have placed. Chuck, if you can send me an email at info@optionsplay.com, I'd be happy to look into your account and give you that information. Any other questions? Charles asking, how about buying a long dated call and selling calls each month? Great question. This is what we call a poor man's cover call, meaning if, let's say, we talked about selling a cover call requires at least 100 shares of that stock. So Intel's trading at $49.25. So to buy 100 shares, you need $4,900. What if you don't have $4,900? What can you do? One of the things you can do is you can buy a long dated option, which gives you very similar risk profile to owning the stock, especially if you buy a deeper in the money call. So here, as you can see, I bought a June 2019 $40 call, so a call that's $10 in the money. As you can see, these two graphs are very, very similar. That gives you same upside return if the stock goes higher, and actually gives you less risk if the stock drops significantly. But as you can see, instead of costing $4,900, it only costs $1,100. This is exactly why, for those of you that may not have the money to buy 100 shares, this is what we call a poor man's cover call. So you can replace owning 100 shares with just buying a deep in the money leap option, and you can sell calls against that leap option, because at any time, if the stock gets called away, you can exercise your leap option to deliver those shares. So this is really one way that you can also sell cover calls against assets that you have. Even if that asset is not 100 shares of stock, you can always buy a leap option in exchange for those or in lieu of owning 100 shares of that stock. Great question, Charles. Any other questions? No, you cannot change those scenarios once you've saved them. You can certainly save as many as you want, but you can't go back in time. You can certainly save as many as you want, but we don't allow you to change them. And the reason part of that is because we want you to be able to save the trades exactly the way you had intended, you had looked at it the day that you picked it. Irina, thank you very much. Again, if any of you have suggestions for webinar topics for July, please type them into the chat window. Happy to kind of consider those as we put together our schedule for next month. Where is Delta shown on the Options Play page? A few different places. So you can click on the blue expand button, and there's a button here at the bottom that says explain strategies in Greek. So you can see Delta, Theta, Gamma, and Vega right here, and we try to break it down in plain English for those of you that are newer to options trading and you don't know what delta means. It explains delta and theta to you in plain English. Again, this is really the philosophy that we have with options play is we want to make options as accessible to as many people as possible, because we understand that when you're looking at a page that looks like this, it's overwhelming and confusing, and there's a lot of numbers, and sometimes you don't know what all those numbers mean. We wanted to break them down for you so that you understood them better. So we had things to explain the strategy to you in plain English and explain all the Greeks to you. You can find them again all just by, for any strategy that you're looking at, you can click on the blue arrow, and that will give you the option to look at the delta or all the Greeks, not just delta, as well as just a quick explanation for the strategy. Any other questions? If there are no other questions, again, I want to thank everyone for taking the time out this afternoon. Like I said, this webinar is recorded, so we'll send that out in about 30 minutes. Like I said, those slides will be included in that email, so please make sure that you take a look at those slides. There are some great links in there for you. Links to our YouTube channel, which gives you a list of all of our webinar recordings, so you can take a look at some of those. Very, very useful to helping you better understand how to utilize our platform for all the different types of trading you do, other than just cover calls. If there's no other questions, again, like I said, I want to thank everyone for taking the time out this afternoon, and I will see you guys. Actually, next Thursday is the day after July 4th, so I think we'll probably skip that week because of the holidays, and we'll be back the following week. And I'll put together the webinar schedule next week and send that out so everyone can see what we'll be doing next month. Thank you, everyone, for joining. I hope you guys have a great afternoon.